Welcome to ETF Leaders, powered by New York Stock Exchange. I am Lara Crigger, Editor-in-Chief of ETF Trends and ETF Database. I am joined here by John Feyerer, who's the Head of Innovation and Commercialization for Invesco. Thank you for joining me.
Great to be here. Thanks for having me.
Okay, so there are a lot of challenges posing investors in 2022. How can investors kind of manage their risk for their portfolio?
Well, certainly when you look at what we've seen thus far this year, has been really elevated equity volatility that we think a couple of key inputs are going to continue to point to that for the foreseeable future. When you look at the backdrop right now, rising wages, Fed tightening, slowing economic growth based upon ISM really trending downward since the middle of last year. And then against that backdrop, geopolitical uncertainty with the Russia-Ukraine situation. So we do feel as though that is something that we are going to see equity volatility continue to be elevated, particularly related to when you look at the last 5 to 7 years where it's been historically low. So we do see that as a reality that investors are going to have to deal with. But the thing to keep in mind with that is just really to how can investors be thinking about staying invested? Because one of the key things that we like to point to that is, if you look, there's recently a study done, 1991 through 2021, so 20 years, looking at and force ranked all the days in that time frame in terms of best trading days. If an investor missed just the best 5 days within that 20-year time horizon, you're looking at their return being actually cut in half. So it's really it's a situation in which investors, even in times that are as uncertain as these, it's important to be thinking about strategies that can help them remain invested.
Are you concerned about inflation at all?
Certainly. You look at this morning, we saw the latest 8.5% rise year over year in CPI. Even the CPI X, the core energy and food, we ended up seeing that up almost 7%. So it's certainly, whereas 6 to 8 months ago, talking about inflation is transitory, inflation is indeed the reality that investors are going to have to be dealing with here going forward. It is interesting, against that backdrop, though. Just literally a year ago, we were looking at 1.7% year-over-year inflation. So big picture change certainly for investors as we look at the balance of this year.
Well, how should investors be positioning for this?
Well, certainly, we've looked at commodities and real assets tend to do really well in terms of helping to hedge investors against inflation. It is interesting, so often gold is pointed to as a potential solution there, and it's interesting, the data shows that when it's inflation shocks, gold tends to do well, but when you see a prolonged, more of a protracted span of time in which inflation is a reality for investors, a broad basket of commodities can be a good hedge against inflation. So we offer an ETF ticker PDBC, which is a broad basket of commodities, no K1 ETF. That is really, can provide solutions for investors to be able to allocate very simply and efficiently to their portfolio and getting commodities into the mix for their investment portfolio.
Makes a lot of sense. So as an industry pioneer, industry leader, Invesco has a truly massive lineup of funds, something 240 funds or more across your lineup. Do you have any that are your favorites?
That's a tough question because I've been in part of the firm for quite a few years now, and there's quite a few that I've had a direct hand in helping to bring to market. But I'd actually say one that really tends to rise to the top is one that takes the benefits, as we talk about ETFs, the low cost, transparency, tax efficiency, those things that investors have really looked to from ETFs, but brought about and provided a solution for an issue that investors are increasingly recognizing, and that is concentration risk. If you look at the traditional indexes that are so popular and so often delivered via ETFs, concentration has become more and more of a reality. If we go back just 5 years ago, the top 10 names in the S&P 500 were roughly 20% of the index. Today they stand north of 30. So you're in 2% of the names now represent 30% of the weight of the index. That's a real issue for investors. So we offer an equal weight ETF. RSP is the ticker, the S&P 500 equal weight ETF. Very simply, it takes the allocation and evenly distributes across the 500 names and provides a solution for investors to address that very issue of concentration, significant concentration. So as we like to say, equal weight RSP takes the concentration out of the S&P 500. So that tough question, but one that bubbles at the top, RSP.
It's a little bit like trying to pick your favorite child, I'm sure.
Well, not easy.
Thank you so much, John, for joining me today. That was ETF Leaders powered by New York Stock Exchange. Thank you for watching, and we'll see you next time.